Thank you, Chris, and thank you, Alex, for a very, very nice session. What we intend to do for this one is to basically get into some of the data points that Alex talked about. So normally we get asked basically similar sorts of questions around basically in strategic beta options. So I thought myself and the actual panelists here, I'd try to get more of the stuff that or the questions that we hear from advisors out. So I'm your moderator, as Chris mentioned. My name's Kunal. I've got with me Jonathan Sheed from State Street Global Advisors and also Russell Chesler from VanEck Australia. Welcome, gentlemen.
Thank you.
So, guys, both of these individuals are not shy to bring forward their opinions, so I expect a reasonably robust panel. How we are going to actually run this is these are essentially the topics that we get asked all the time. So we've essentially segmented our discussions in these to basically go into some of the actual perspectives within these 6 topics. So but in the meantime, if you do have any questions that do come up, I'm happy to make this reasonably interactive. I'll prompt you a few times as well. We're happy to take questions in the end, or even if there is anything super duper pressing, put your hand up and we'll go from there. So welcome, gentlemen. The first thing I want to actually get out there is to ask, so what does strategic beta mean to you? Because there is a huge amount of subjectivity around this term. And are there any other interchangeable terms that essentially can be used for it? Sorry.
Yeah, there are a huge number of terms, and I think the industry is united in hating the term that someone else is using. Smart beta, factor investing, strategic beta, etc. I think from an advisor point of view, maybe styles might be another way of thinking about it. Our taxonomy, love that word, great work, Alex. Our taxonomy at State Street is probably a little bit shorter. We tend to think value, size, quality, low volatility and momentum, and probably dividends as well. So they're the sorts of investment ideas that are pretty familiar to you. The way Alex expressed it, sitting halfway between active and passive, I think that's a good way to think about it. That's how we would characterize it.
Russell?
I think we'd characterize it slightly differently. I think if you take a step back and go back to the Greek alphabet and look at alpha, that's the performance above a benchmark. Beta is the performance of a benchmark. So in Australia, we've got the ASX 200's the benchmark, which is a market cap benchmark. So you've got like CBA, largest stock in there, that sits at 9%. So from our perspective, put simply, strategic beta, smart beta, whatever you want to call it, is anything that doesn't weight according to market capitalization. Something that's trying to target a specific outcome for an investor, and many of the products that are around are trying to do better than the market. They're aiming to outperform, just like some of the active managers out there.
So I wanted to take just one thread that you guys sort of touched on. People always talk about whether it's active, whether it's passive, where is it? So from your perspective, Jonathan, active or passive? Is strategic beta active or passive?
You've got to be a fly on the wall at State Street because we have a very large active business and a very large passive business. So it's always an interesting discussion. If you think about, the easiest way I think to describe it is with an example. If you get your classic active value manager and they have a fantastic year, right? You've always got that discussion at the end. Did this manager do well because it was a great year for value, or did this manager do well because they're a really, really good manager? And what strategic beta tries to do is to separate those two. And that first bit, if value's had a really, really good run, well, you should be able to get exposure to that without paying an active fee. So really, it's part of what active managers deliver, but only a part of what they deliver, but for a really low cost. It's almost like in value example, you're saying to a value manager, if you think you're so good, I can get this much value exposure for a really low cost, beat that. So it's a little bit of active, while at the same time not being quite passive market cap ASX 200.
Yeah, I would say it's probably somewhere between, just like Alex says and Jonathan said, somewhere at the intersection, you could say, of active and passive management. So you're getting the benefits of being passive, you're getting low cost, low turnover, at the end of the day, something that is really transparent and at the same time is targeting a return. But I think if you look at the strategic beta or smart beta offerings out there, there's a wide range. Some are quite simple as equal weighting, and others apply a number of filters and factors. So I'd say some are a lot closer to active, and others are closer to passive at the end of the day.
Cool. One of the things that actually stood out at me with regards to Alex's presentation is the actual rate of change. So the absolute number within strategic beta is, still lower than, your standard passives and things like that. But the rate of change, or the gradient of that line, in terms of the increasing in popularity, is quite staggering. So for you guys, I mean, why do you think they've actually been popular? But I want you to think about, like, has something changed? I mean, is technology better, or is the market dynamic more amenable for these types of products, and that's why the popularity is there?
And Russell may have different perspective on this to me, but I think the technology side is true, but it's not technology in a kind of a Facebook artificial intelligence last 2 or 3 years type technology. It's technology going back 15 years with kind of democratization of data. I think the change that large asset managers like us have seen is in the institutional space. And believe me, the largest asset owners in the world have been looking at this for the last 5 to 10 years. If you're running a portfolio of several $100 billion, this sort of stuff is really, really interesting. So what we've seen is in the institutional space, a huge amount of interest in this, a huge amount of development about how these principles can be applied. And so we think it is only natural that that will actually spread into the advisory market, spread via ETFs, become sort of democratized.
Russell, anything?
I do agree with what Jonathan said, but I'd like to make three points. And I think the first one is, if you compare strategic beta maybe to the automotive industry, if you take a look at all the innovations, they always tend to happen in the luxury brands and then at the very highest model within those brands. So if you look at Mercedes, they were the first to come out with ABS. They were first to come out with airbags. What happened 10 years down the line? Every car had it. So what we really are seeing is essentially a repackaging of what's been in the insto space, what's been used by some active managers, into a really affordable, put together in a really affordable way so that investors can easily access these strategic beta investments. The second point I'd like to make is since the global financial crisis, expectations been more of a low return environment. So investors want more. They want more than benchmark. And at the end of the day, they don't just want benchmark at a high fee. They don't want to take on additional risk. And the third point I'd like to make is that we are seeing at the moment, if you look, and it may be cyclical, it may change, but you're seeing an underperformance coming through on active management side, and there's definitely a correlation between that and the move to passive. If you look at our market, if you look at the US market, I think over 3 years, passive went from 25% of the US market in mutual funds. It's now up to about 33%. So I think I'm not saying there's no place for active. I think there's lots of place for active. But I think where active managers are going to struggle, those active managers are really benchmark huggers. I don't think there's really much of a place for them in the future. I think they're going to lose assets. If you're high conviction, high concentration, and you can produce the returns, that's where investors will go.
Cool. And just in terms of your perspective, Jonathan, so State Street run active and passive mandates, and smart beta mandates as well. Like, do you actually think the movement of money away from, say, active into passive or quasi, etc., is because of what Russell kind of alluded to about the disappointment in the repeatability of the active manager's alpha, or is it a fee-driven thing that's?
Some of it is fee-driven. So if you think about on the institutional side, large asset owners are under cost pressure. The same thing is happening in the advisory market. There's a lot more of a focus on fees, so there's no doubt that some of that is fee-driven. However, not all of the move is dissatisfaction with active management. I think active management is certainly under pressure, both on the cost side and on the value side, but some of it is actually coming from passive, existing market cap passive assets. I mean, Russell's point about a low return environment, we're seeing a lot of investors saying, you know what, I get efficient market theory and all the rest, and I get low cost, but I need a little bit more out of my assets. Is there a way I can do it kind of in a sensible way over a long term without increasing my cost too high? So some of it is coming from passive, some of it's coming from active. It's a mix.
Russell, we sort of see most of the evolution in equities type strategies. Why have people been kept out of having a, you know, some sort of a index or like rules-based approach to, say, fixed income?
Well, I think we're starting to see that, but yes, it's been slow. If you look at the US market, a quarter of the US market, ETF market, is actually in smart beta. Out of the 800 funds there, you've only got 3% of them sitting in fixed income smart beta. And I think it's largely one of these things. There's liquidity issue with some fixed income. There's transaction costs, but more importantly, until recently, and there's still issues with it, obtaining data on the fixed income market is a lot more complicated. Most fixed income, for those who are in it, know that it trades over the counter. There's no ASX that you can go and hit. You have to go out to a number of brokers. So I think that has slowed it down. Certainly we're starting to see it, and just last week we launched our first smart beta fixed income fund on the ASX, and that's called Plus.
Cool. Another question we always get asked as well, but how, I mean, if everybody is chasing a factor, let's just call it value, right? But you know, value, if a weight of money goes to value, when does it stop being value?
Actually, value is an unusual case. So if you take quality, if the weight of money goes to quality, quality can get very expensive. The whole value argument, the weight of money, is actually a self-fulfilling prophecy, or no, I don't even know what you'd call it, but if everyone goes to buy one bunch of stocks, they cease to be value by definition, and they go chase something else. But I think to come to your point, smart beta is not introducing some new source of crowding. There are investors who've been looking for quality stocks for the last 15 or 20 years. The fact that a smart beta quality fund or strategy attracts a lot of assets doesn't say anything about smart beta. It just says there's an appetite for quality right now. Sometimes that appetite will be satisfied through active products. Sometimes it'll be satisfied through strategic beta. I used the word smart, didn't I? Strategic beta products. So it's a mistake, I think, to think that somehow strategic beta is a source of crowding in markets.
I think it's also, some people also say sometimes, you know, ETFs are causing issues in markets. People are investing more in a particular sector. And to Jonathan's point, people are still going to invest in there. It's just giving them a very different way to invest. I think if fortune or money was flowing into a particular strategy and was looking overvalued, then you'd certainly have active managers and hedge funds out there who would come and short those positions. There'd always be somebody who's going to take the opposite position. There's going to be somebody who's going to say, these stocks are too expensive, they need to come down in price.
Cool. So guys, just shifting gear into actually defining some of the offerings. I mean, one of the biggest ones that we've seen a lot of flow go into is the dividend or the yield products. So Russell, can you maybe talk about how you essentially, what rules you apply to, say, a market cap weighted index to, you know, in some of your offerings, to also capture not only high dividend, but also the sustainability of the dividend?
Well, I think if you take a look at most of the dividend, or there's the numerous dividend products on the market, the aim is always you want to achieve a better dividend of the ASX 200. So you need to choose a subset, you need to choose those higher dividend yielding stocks. And typically you'll see probably between 30 or 60 stocks in the portfolio. So that tends to be relatively concentrated if you look at it from that perspective. And the next step, which different products do different things, you could weight by dividends, which is probably the one which I consider to be a little bit more radical, weighting by the size of dividends, because then you get a very different kind of weighting coming through, or you can weight by market cap. But when it comes, certainly when it comes to the Australian market, you have the issue, the highest dividend paying stocks, of course, in financials and the banks. So most products will tend to lead to an overweight in the banks if you didn't somehow cap a sector. So most of the products out there do have some sort of capping on the financials so that you don't get too overexposed to financials. Cornell mentioned as well, building in maybe some other factors. Most of the products out there do have some filters. There might be dividend sustainability, looking at from an earnings perspective, and really those are put in place in a way so that funds aren't actually falling into a value trap. You aren't just choosing the highest yielding stock. It might have performed very badly, and that's why it's got a high dividend. So it's trying to protect to an extent against that.
Jonathan, I guess, how do you objectively define, in sort of the same way, I mean, you've got some quality factor tilted solutions. How do you objectively define quality?
We were asked this question by a large institution about 5 or 6 years ago, and this institution came to us and they said, hey, could you build a quality kind of strategic beta portfolio? And we said, well, okay, how do you want to define quality? And they said to us, no, we ask you. So we kind of went away and did the research and said, we thought quality was really low leverage, kind of stable earnings, quarter on quarter, and high profitability. ROE, ROA, however you measure it. So we kind of, now since then, I think you've seen indices come out from third-party vendors largely reflecting that. The great thing about strategic beta is investors don't have to second guess. This stuff is all publicly available. And if there's a kind of a quality index, or if there's an index that includes a component of quality, usually how that is defined is publicly available.
And just a question, I mean, let's say you launch a product and you apply some rules on a passive, market cap weighted index. Do you have the ability to perhaps, 3 or 4 years' time, when other factors or other say ratios may help that, or be more, sort of, tilted towards that, say, quality or whatever? Do you have the ability to go back and then add those and remove? Not in an ETF space. It would be a bit like saying, I've got an ASX 200 product and I'm now going to change it to the 100. Well, actually, you'd need to go to all your unit holders and get permission and so on to do it. We actually think that that taxonomy, those sort of 4 or 5 or 6 factors they're not the last 5 years. They're like, as Alex said, they're on the basis of 20, 30, 40 years of academic research. We don't think that's going to change in a hurry. So, our attitude is if we launch a product that's got these, 3 key factors in it, we have a product that's got quality, value, and low volatility. Those have been around for decades. We're not likely to be adding or removing or changing.
I think what you do see, though, is people do tweak their products. You do make changes to make the products. People do make changes to make the products better. They might change some of the filters, particularly in a dividend product. They might change some of the definitions of when a stock comes in or when a stock comes out. So I think it's not as if it's the strategies are put in place and product providers look at it and set and forget. Certainly ourselves at VanEck, we're always looking at our products and we're always discussing with our index providers and seeing if there are ways in which we can change it and make it better for investors at the end of the day.
So just a quick one, in terms of equal weighting, Russell, how do you determine whether you should have 2% in stocks, or 2% in 50 stocks, or 1% in 100 stocks? How do you get to that actual what the weight should be?
Well, I think maybe just taking a step back, because equal weight is relatively new to Australia. We launched the first equal weight fund 3 years ago. They've been around a long time in the US and in Europe. They've got well over a decade's record in those markets, and there is a significant body of research out there showing how they've actually outperformed probably market cap and a lot of other fundamental and factor-based strategies In fact, if anyone's interested, there's a very interesting paper that was put out in 2013 by our own CSIR and Monash University, where they identified the reasons why equal weight outperforms. And the reason we launched it in the Australian market is, as you all know, very concentrated market. Top 10 shares, 47% is in the top 10 shares. We've got 40% in financials. If you look at our equal weight ETF, that's down to 12% in the top 10 and 20% in financials. But coming to back to the original question, is how do you decide how many? So if you look at the original equal weight product on the S&P 500, you had 500 stocks equally weighted. Now, interestingly enough, number 500 in the S&P 500 has a market cap of US 4 billion. So it's a big share. Australia, number 200, can anyone guess? What's the market cap of number 200? No one out there? 350 million. So much smaller, much lower liquidity. So equal weighting the top 200 in Australia makes absolutely no sense. So when we looked at it, we looked at liquidity screens as well as market cap size, and we wanted to cover around about 90% of what we called an investable universe, and that came down at the moment, that's 83 stocks. So it's 83 large and mid-cap stocks that we've got equally weighted. So they've got the right liquidity in the market, they've got 83 is more than sufficient to give the right diversification and reduce that concentration risk. So I think you've got to go through a number of steps in putting any index together to make sure that it actually is logical, makes sense, and delivers the right outcomes.
Just stepping into one of the biggest things that people grapple with, and people have their own views on, is how do you actually measure or benchmark these strategies and set not only the person who's applying their expectations, but also your client's expectations, right? So Jonathan, I mean, look, it's really hard to build a custom benchmark, right? So putting that aside, how should investors be benchmarking these types of strategies to measure whether they are successful or not?
The cheat answer is usually there's a published index that you can measure it against, right? That's the cheat answer. The long-term answer is you measure it against market cap. In most cases, you just measure it against market cap over a 5-10 year period. The kind of nuanced answer is it depends what it is you want to achieve for your clients. I'll give you an example. If you have a portfolio where your first and foremost priority is to be defensive, then you may measure it by saying, does this achieve lower drawdowns? Does this have lower risk than the index? It may or it may not outperform. That's not the point. That wasn't my goal. On the other hand, you may just have a general, I want to outperform the index over a reasonably long period of time, and I don't want to have too much variation. That's a different kind of measurement. When we put factors together for the kind of global blended strategy QMix that we have on the ASX, we deliberately chose kind of return-seeking factors like value, and then more risk-based type factors like quality and low volatility to try and get that balanced outcome.
And Russell, is it fair to compare them against active managers to make sure, and sort of Jonathan alluded to it at the start, is that if you're actually going to allocate to somebody who is proactively a value type of manager, is it a reasonable thing to do to say, you know what, I can actually benchmark you to something which essentially gives me a tilt to the factor?
I think it is. I mean, I think to a certain extent it is to benchmark it against active. I think, again, it depends how far across the spectrum you are in terms of looking at passive. Certainly, if you're looking at a strategy that's looking to outperform the market and it's looking to outperform market cap, investors should be expecting maybe 1 to 3% above the market. I mean, and that's somewhere we'd look, for example, on our equal weight strategy. However, if investors looking for a low vol strategy, well, maybe a better measure is looking at things like drawdown, volatility, maybe adjusting that return to take that into account. Because obviously, if you want lower vol, you're not going to expect as high a return.
So guys, just moving on to one of the key things, I think anyway, is around factor selection and portfolio construction, right? So if we can spend just a little bit of time there, I mean, what should, I guess, Jonathan and also Russell as well, I mean, what should people think about when actually thinking about which factor to choose in their portfolios?
It's really important in strategic beta. People talk about strategic beta like it's a thing. It's not. It's lots of things. And it's really important that you look under the hood and that you're comfortable with the economic rationale behind the factor that you're getting exposure to. So value, all heard of value investing, fine. Size, equal weighting is an example of tilting towards smaller size. Smaller companies tend to do better over a long period of time. Familiar with that. Quality, there's lots of research around quality going back to the 1930s, but again, you need to be comfortable that that's a factor you're happy to get exposure to. Low volatility, research on low volatility goes back to the 1980s. The fact that securities with lower volatility tend to produce a better return than you would expect. They do much better than they should, according to sort of capital markets theory. So it's really important that you look under the hood, you understand the factors that you're getting exposure to, you understand things like, is this going to be a really concentrated portfolio or is it going to be a gentle tilt? And that, I think, is kind of the key thing you need to understand.
Russell, just a quick one. I mean, in terms of just taking that train of thought forward, what should investors look for with regards to the index construction to make sure that there's actually not too much slippage away from what they want versus what the index actually gives them, or the enhanced index?
Well, I think it's important to make sure that it's not like, you get active managers out there that say that they value, but they're not actually. So you need to make sure that you're actually getting the style that you want. So if you do look at certainly some of the indexes out there, you might be getting value, but you'll be getting some other factors creeping in. So if you're looking for value, you should be looking for an index that has the highest possible skew. If you're looking for quality, the same thing. So you should be looking, how did you expect it to perform in the past? How did you expect that index to perform? Like, for example, quality didn't perform very well from 2004 to 2007 when you had growth coming through from companies where they were just using leverage. So you need to make sure that it's looking the same as what you'd actually expect at the end of the day. And I think one very important thing to look at is you'll see every index, it'll have an inception date, and that's the date on which the index went live, that's the date on which it's real, and then it'll have a base date. And that base date is a back-tested date at the end of the day. So you need to differentiate between what was actually back-tested and what was actually real as well when you're considering one of these strategies.
And I'd add that the kind of the backtest issue, the more funky the definition or the way the index is constructed, the more suspicious you've got to be aware of backtest. The more plain vanilla, you can have a backtested index that actually uses academic research that's 30 or 40 years old. You place more reliability on that than something that looks a little bit funky.
So guys, we are sort of getting to the end. I put the notion out there that if you've got any questions, please raise your hand. I'm happy to take a few now if there's any pressing things. Yes.
Thank you. In relation to smart beta ETFs, iShares have just recently put out an Australian market equities and an international equities one based on 4 factors equally weighted. Are we going to see the development of multi-factor ETFs where the factors themselves are not equally weighted and some qual decision is made about the weighting of the factors? Second part, all this development in smart beta stuff is happening in ETFs. Are we going to see any of it? Are we going to see some managed funds put out? There's a great lot of advisors out there that just use managed funds, and it's very difficult to introduce listed entities into our models and our portfolios. So I'd like to see that.
Well, maybe I can tackle the first one. We launched a multi-factor global ETF. In fact, when we were launching the first of our global smart beta ETFs, we had this choice. Do we do single factor ones or we do multi-factor? We decided we would launch a multi-factor. I think timing factors is phenomenally difficult to do. And so in a kind of transparent, what you see is what you get, low-cost kind of structure, I don't think we would be looking to try and time factors anytime soon, just because it's incredibly difficult to do. If you just take the analogy of the market versus cash, if I came to you and I said, you know, how good are you at timing the market versus cash? You go, you're right, you're serious? Well, timing factors is no easier than that. So we're not about to be trying to time factors anytime soon, I don't think. I don't know if you want to...
I think where you see maybe possibly timing of factors is you have insto clients. Like if you look at some of the industry funds in Australia, they're putting together research teams to look at whether they can time factors and that. So we have specialists actually looking at that. I agree with Jonathan, I don't see that coming really anytime soon to the Australian market. I think to your second question, you know, why aren't there managed funds out there that are doing strategic beta at the end of the day? And I think it's really been the development of the whole market, and that passive has become more of a, I guess, an ETF market. I mean, there are passive managed funds out there, but certainly the ETFs have grown that side of the market. I mean, I'm sure if there's sufficient demand, somebody will put out a managed fund. I mean, in the US, what you've seen is managers like Franklin Templeton and the like coming out with their own index strategies now, because index has become so big. They're coming out with their own way of putting together indexes and that, and that's something you might see in the Australian market as well, where active managers actually start to look at their process, is it quality, and put together their own index type of products.
Great question. Is there any others?
Russell, just while we're waiting, I'd actually challenge you and say that there are managed funds with factor-based tilts out there, like Vanguard with its dividend-focused and market cap-weighted and things like that. So,
I'm going to go down a limb and guess that we both might have known that. Just, you know, feel the need to mention it.
What's the key difference between a quant fund and a smart beta fund?
Yeah, that's a great question. I know that when I talk around the industry, quant is this horrible black cloud, and anything that involves a PC lives under that cloud. If we look at our active products, you get things like factors that are proprietary, how we define factors. There's timing of factors. There's how we bring the portfolio together. So conceptually, in active type products that we would run, the client comes to us and says, this is what I want to achieve. Highest possible Sharpe ratio, for example. You just do what you've got to do to make that happen. We'll use some factors, we'll use some proprietary stuff, we'll use some portfolio construction, but we're delivering to an end result. In smart beta, we're delivering a factor exposure. So in a sense, one part of that decision rests with the client rather than with us. The client's already decided, I want to get exposure to quality, value, and low vol. And we can then deliver a product to that.
Russell, do you have anything to add? Or?
I don't think so. I think that covers it.
Okay. Any other questions? Just while people are thinking about it, just in terms of, you know, how should fees is a massive thing. You talk about dark clouds or even a silver lining. I don't know what you want to do, but it depends on which side of the fence you are. But how should investors judge the fees within strategic beta? Because there is a bit of a dispersion in fees.
Yeah, I like Russell's analogy about Mercedes earlier on. I drive a Kia, just for disclosure. This idea of costs coming down. And so in the early stages of strategic beta, some of the costs were really relatively high. I think we're getting closer and closer to the point where strategic beta doesn't look that much more expensive than a normal market cap kind of strategy. You're starting to get to a point where it's almost an economies of scale argument. So if your market cap product has got 3 billion in it, and then your strategic beta product has got 100 million in it, there's some economies of scale there, but there's not a huge amount to differentiate fees beyond that.
I think to me the fees are really low. If you compare to active managers, generally if you look at strategic beta, they're probably around about a third of what you'd be paying an active manager. If you look at most of the products on the market at the moment, they're probably between maybe 25 and maybe 50 basis points. So yes, more expensive than maybe general market product, which you might be able to get for 15 basis points. But at the end of the day, if you look at the additional return it's generating, you're not paying a hell of a lot more, maybe an extra 15 or 20 basis points there.
Cool. Well, thank you, guys. I guess I know Chris is shuffling here, but 10-second soundbite, guys. I want to link this to the sort of the main theme of the conference. So strategic beta, how do you think it's finding order in the new disorder? 10 seconds soundbite.
Democratization of active management, I think.
Perfect. Russell?
I think it's a really powerful option that can be used in any investor's portfolio.
Cool. Well, thank you, guys. Please thank my speakers, Jonathan and Russell.